So we're going to be going into chapter or unit 14. I still call them chapter 14, even though they've changed it up now. We're going to be talking about different loan types. So today, what we're going to be going over is this. We're going to be talking about the FHA loan, VA loan, conventional loan, because it's important to know kind of what are the benefits of those, what the differences between each one of them, what each organization does, kind of like that stuff. So where I like to start is this. I like to start with an FHA loan. And once we go through these loan types, the next thing that I want to do is tell you about amortized loan, partially amortized, all that kind of stuff. So there's a couple of things that you're going to get out of this chapter. And again, we'll go through all this stuff and it should be pretty clear to you. But what I'm going over is really kind of like the nuts and bolts of what you need to know, like basically the simplified version of everything. So who here has heard of an FHA loan or knows what an FHA loan is? So an FHA loan is an FHA insured loan. Stu, who is the FHA? Yeah, so that is government backed. So for everyone who's typing government backed on there, absolutely. The FHA, so people always think that it stands for Fair Housing Authority or Fair Housing Administration or Fair Housing Association. It stands for the Federal Housing Administration. So I'm going to tell you what they do and why they do what they do. Okay, so what happens is this, an FHA loan. So imagine this. Imagine you have a bank here, okay? We're going to put the bank as the meh face, okay? Then you have a happy little buyer over here. Now, the bank says to the buyer, hey, do you have a lot of money to put down? They go, nope, we don't have a lot of money to put down. Then they say, hey, do you have a good credit score? And they may or may not say that they have a good credit score. Let's say, for this example, say that they don't. Then what happens is the bank's like, yeah, we don't want to lend to you. We don't want to lend you money. And then what happens is the FHA comes in, the Federal Housing Administration, and says, wait a minute, Mr. Bank, listen, what if we did this? What if we insured the loan? So if you lend to this person right over here, we'll insure the loan for you. So what happens is this. Basically, what the FHA does is they vouch for the buyer. Okay, they insure the bank on behalf of the buyer. Now, the benefits to the buyer for taking out an FHA loan: there's a lower down payment. Okay. And you can also have a lower credit score. Now, what is the, downside of it? What is the situation that you might want to be concerned with? Well, what happens is this with an FHA loan, okay? What happens is this. The FHA is going to charge the borrower, okay? They're going to charge the borrower mortgage insurance premium. So you're going to have to pay mortgage insurance on this. Okay. So let me just put that in there that you'll have to pay MIP or mortgage insurance premium. Okay. And what that is this. Listen to what I'm going to tell you. That's paid directly to the FHA. And that is basically how the FHA is funded. Okay. So the FHA does not lend money. Very important to note that they are not lenders. They are not lenders. Okay. People always say that, oh, they lend money. No. Nay. They do not lend money. The FHA insures the loan. Basically, they vouch for the buyer. They say, oh, you know what, Mr. Bank, if you lend to them, we'll make sure that everything's on the up and up with this. Okay. That's what's going to happen. So FHA loans, benefits to the borrower is that low down payment. They could have a lower credit score. Okay. So someone put in the chat that there's stringent guidelines for inspections. Yeah, because what happens is this. Because there's a higher risk of default because it is a more risky, like the risk is higher than in other loans, then what happens is the bank is going to want to make sure that the condition of the asset is up to par, that it's going to be easily marketable. Okay, they don't want you buying a poop hole and then basically not bringing it up to snuff. So that's the situation there in regards to that. So any questions on FHA loans so far? We got other loans to go over, but that was the first one I wanted to go over because the other ones kind of fall in line when you understand FHA, what the FHA does, which is they insure loans, and what the benefits, what the downsides, all that kind of stuff are, then you could easily understand the rest of them. So, no questions. Good. VA loan. So, VA loan. So, someone said in the chat, once you get enough equity paid, you can remove MIP. Nay, nay. Nay, nay. Okay. That is because you're thinking of, it's not an equity, it's going to be for the life of the loan. Okay. For as long as you have an FHA loan, you are going to have, because that's basically the function of it. Okay. You're basically paying the FHA to insure the bank. So the FHA is always going to insure the bank for the loan because of the higher risk. Okay. They're always going to do that because that was basically the deal you made with the devil there. Okay. And what happens is, as long as that loan is there, then what happens is the FHA is going to be paid. Okay. Could you remove it if you refinance? Practical questions. Yes, you could definitely do things like that. Yes, because obviously if the loan has ended, if you refinance and paid off the FHA loan and then taken out a different loan type, like a conventional, yes, you theoretically could have MIP taken away. Okay. You're thinking more of the mechanisms that we'll get into with conventional. You're thinking more PMI than MIP. MIP is for the life of the loan. Okay. So if you sell your property, yeah, absolutely. The loan would probably be paid off. Okay. Probably, I say, most likely. There are circumstances where there might be other things that might happen. However, you're probably going to be paying it off, like in a practical sense. And here's what I'm going to tell you. I could go down rabbit holes whenever we're talking about things in the classroom setting and even on webinars and things like that, but what I like to do is this. I like to try to keep everything nice and tight so that you get basically the simplest, most concise story that you can about what an FHA loan is, what a VA loan is, what all these topics are. So whenever you hear me talking about this stuff, basically what I'm trying to tell you is the shortest answer. And I might not go down every rabbit hole because it's just like one of those things that it's very practical. And although fun to discuss, not going to be things that you need to know for the test. So that's why I'd say, as far as the refi, getting it removed, all that kind of stuff, I don't see scenario questions that you're going to have on your test for that. But let's move on. Let's go to a VA loan. So what do we know about a VA loan? What is that? So that is for veterans. Yeah, absolutely. So what happens is this, and now you have to, there sometimes you might have to know what it is to qualify, but I haven't seen that on the test, so I'm not going to go through that. So this is for veterans, okay, and qualified veterans, okay. And it's going to be a guaranteed loan, guaranteed by the VA. So again, the VA doesn't lend money. Always understand that. The government entities don't lend money or do things. Okay, they don't do that. So it is a guaranteed loan. It is a guaranteed loan. So because it is a guaranteed loan, a little better than insured, this is going to allow the veteran to pay no down payment if they would like. So they could have a zero down, okay, loan. They could just sit there and do that. Now, they have to live in the property. Veteran or spouse must live in the unit. So it has to be primary residence. It has to be primary residence. They will not do it. So you can't just take out investments and just start buying up investment properties and go, we zero down. Yay, I'm going to buy 7 homes. No money. No, can't do that. Nay, nay. Okay, nay, nay. You cannot do that. So the VA loan, veterans, okay, it's guaranteed by the VA. There's no down payment requirement. Nope, does not transfer to children, not to children. So children cannot do it. Is for it is for the veteran or their spouse, or if it's a widow or widower, they could also do that. So it will not transfer to kids. So if your parents have served in the military, you cannot take out a VA loan. Okay, that is not something you could do. So that being said, we have one last loan type that I want to go over, okay? And that is a conventional loan. Now, let me ask you this. Where do you go to get, because I didn't go over this, but I want to ask the question. Where do you think you go to get an FHA and a VA loan? Like, where would you go? Would you go to the FHA or VA? Would you go to the FHA or VA? I don't know. What would you do? So you go to regular old banks, so long as they're approved as an FHA lender, okay, or a VA lender, you are going to be able to, do all of that, take out an FHA or a VA loan. You're going to be able to do all that stuff, okay? So, and it's not any banks, but it's usually, because remember, they have to be approved. So that's why I see in the chat you typed in any banks. Most banks are approved FHA and VA lenders. However, there might be some smaller banks that do not handle those loan types. So does anyone want to take a stab at what a conventional loan is? So we talked about an FHA, we talked about a VA. And I always get this. Someone's going to type in normal. It's a normal loan. It's a regular loan. I love when I see that. Because you're not terribly far off. Okay. Yeah, it is not a government backed. So here's the thing. The reason why I go over that third is because once you understand what an FHA and VA loan are, a conventional loan is kind of easy because it's not government backed. Now, there might be some smaller type of loans like a USDA kind of loan, like, some state level ones have some other bank backing. So basically, a conventional loan is one that is not government backed. Now, the down payment requirements for FHA are pretty low. Okay, they're as low as 3.5%. The requirements for conventional could be low, but they're not as low as 3.5%. So conventional loans do get low. I mean, like there's like a 10% conventional product out there right now. Okay. But there isn't any real, as low as FHA. Okay. And now what I also want to tell you about FHA too, keep in mind, there are a lot of different programs. So don't just think that that's for people who don't have money and who don't have a high credit score. Nay. I've had some investors go with FHA options because they're just like, look, I don't want to put a lot of money down. I want to put the least amount of money that I can down and just pay the rest monthly. Cool. Awesome. Fantastic. Wonderful. That is the situation there. So conventional loan is just one that is not government backed. Now, what I will tell you is this. If the loan to value, okay, is greater than 80%, PMI is required, private mortgage insurance, okay? So someone asked, the credit score had a lot to do with the down payment. It depends on the program. I mean, that's a very specific question in regards to that. It could have an impact on whether they can even go with a conventional product. There's a conventional product that would be out there, or if they have to go FHA. So that's basically the situation there. So PMI is private mortgage insurance. It's mortgage insurance. Basically, the bank says, hey, no one's insuring us since you're not going to be putting enough money down for us to feel comfortable, which basically that's 20. If you're putting down less than 20%, then what happens is you're going to have to pay for private mortgage insurance. That is the type of mortgage insurance that will come off once the loan to value is less than 80%. If the loan is less than 80% of the home value, okay, then yes, absolutely. It's going to be a situation where you are 100% going to be able to remove it. Now, what is loan to value? What is LTV? What is that? When I say that, what do I mean? What do I mean? So what I mean is this. It is, what is the loan amount in relationship to the value of the property? So let me give you an example, okay? If the value of the property was $100,000, I'm just using that number for round number purposes, and my LTV was 70%. LTV is always represented as a percentage. Then my loan amount would be $70,000. Why? Because 70% of 100,000 is 70,000. Make sense? And my down payment would be 30,000 in that situation. So, next question that I have for you: do you have any questions on these three loan types? Are there any questions on these three loan types? Nope. So, let's go over then two more terms that I want to talk to you about. There's fully amortized loan and a partially amortized loan. Now, tempted to do some math with you tonight, but I'm not going to do that. In the math section and on my YouTube channel, I have various different ones where I go over amortization. I go over the amortization tables, stuff like that, because you will get, especially in New Jersey, you will get an amortization table question. There's going to be one. So if you want to guarantee a question on the test, learn how to use the amortization table. It is not hard. Okay. If my pigeon brain could figure it out, you certainly can. So that being said, let's talk about what a fully amortized loan is and what a partially amortized loan is. So amortization means that you're paying. Amortize, actually, the root words from it basically means to kill off slowly, to slowly kill off. Okay. So what happens is this: if you fully kill off a loan, then at the end of the term, whatever the term is, it will be fully paid off. Okay. So if you have a fully amortized 30-year loan, it's going to be fully paid off at the end. Okay. Then you have what is called a partially amortized loan. Partially amortized means that it's partially paid off, meaning at the end of the loan, there will be a little lump sum, a little dingleberry at the end, okay, that you have to pay off. Usually they call that a balloon payment. So partially amortized loans will have a balloon payment, okay? Fully amortized loans will not have a balloon payment because they will be fully paid off. Now, next thing that I want to tell you is PITI. That's a pretty easy one. What is PITI? Anyone want to take a stab at it? You could probably guess it. Don't all jump out of your seats at once. It's principal. Okay. Interest, taxes, and insurance. Because that's usually your mortgage payments, okay? They're usually going to cover the principal, interest, taxes, and insurance because they want to make sure, because the bank actually takes care of your taxes and insurance because they want to make sure that that never not gets paid, okay? That would be a problem for them if they had to foreclose on you. So, that being said, I'm going to end the recording right now. So for those of you watching on recording, thank you very much and have a great one.